Hello, my name's Faith, and today we're talking about accessing the money in your pension pot, and more specifically, how you can use different options together. When it comes to choosing what's right for you, it very much depends on your specific circumstances and goals. There isn't a one-size-fits-all approach, but you can use a mix of options rather than having to rely on one. You might already know about the different options available: pension drawdown, regular withdrawals, taking a lump sum, and buying an annuity. Let's quickly remind ourselves what these options are. Pension drawdown means your money is left invested in the stock market while you withdraw money as and when you like, as long as you're over the age of 55, rising to 57 in 2028. The bottom line here, you decide how much to take and when. Another method you can use is PensionBee's regular withdrawals. This is a type of pension drawdown where your money remains invested in the stock market. But instead of manually withdrawing the money, you can set up a regular payment. You can also take out the whole lot as a lump sum. Then your pension's no longer invested and the money is yours to spend and save as you like. But remember, only 25% of your pension can be accessed tax-free. The rest will be taxable. If you opt for an annuity, this means you hand over a lump sum in exchange for a guaranteed income each month, year, or quarter. Annuities can last either for a fixed period of time or until you die. Let's talk about the ways you can use some of these methods together. First, lump sums and pension drawdown. Rather than taking the whole lot as a lump sum, you could choose to take a portion of your pension pot. Maybe you'd like to pay off some debt, do some home improvements, make a large purchase, or book a trip to celebrate your retirement. You could, for example, take a portion of your pot as a lump sum and leave the rest invested to draw down from as and when you need. Withdrawing a chunk of your pension cash rather than the whole lot could also mean you pay less tax. Only 25% of your pension can be taken tax-free. Withdrawing a large amount could potentially push you into paying higher rates of income tax. But you might be able to avoid this by spreading smaller withdrawals over several years. You don't need to take all your tax-free cash at once. You could decide to pay tax on part of withdrawal, so in future years you can still top up your income with tax-free cash. Let's say you wanted to take 10% of your pension out as a lump sum. You could opt to take 5% out of your tax-free allowance and pay income tax on the other 5%. Second, pension drawdown and annuities. Another option is to use pension drawdown at the start of your retirement and consider purchasing an annuity later in life. You can access your pension money from the age of 55, rising to 57 in 2028. So in the early days of retirement, you might still want the flexibility of being able to access your money whenever you like. But as you grow older, you might prefer the guaranteed income that comes with purchasing an annuity. Plus, you're likely to get better rates for your annuity as you get older. You could also do this the other way round and instead use part of your pension pot to purchase an annuity at the start of your retirement and leave the rest invested to draw down whenever you need. Spreading it out this way over multiple years can help keep your income under the tax-free annual personal allowance. Remember, you can't change your mind once you've purchased an annuity. So if you're considering the annuity route, do lots of research beforehand. Only 25% of your pension can be withdrawn tax-free. Purchasing an annuity is irreversible. And when opting for pension drawdown, your money remains invested and it'll go up and down with stock market movements. With PensionBee, you can set up regular withdrawals, which can help you manage your retirement income.